actually look at financing a car.
Okay.
And what that looks like. Before I get into that, I want to actually show you some numbers and an example. Well, I learned this concept and this strategy when I was 13. Mm-hmm. I was lucky enough to have a dad that was in finance, and when I was younger, I really wanted a dirt bike. So my parents said, okay, you can have a dirt bike, but you have to save up your own money for it. Mm-hmm. And so I was pretty diligent at saving my money for the next 3 years, and I saved up. Every time I earned money and I would save it, I'd give it to my dad to invest. Oh. So when I was about 16, I had about $1,600 in my account, and I found a bike that I wanted to buy. Mm. And so I said, Dad, can you take that money out? I'm going to go buy this bike for $1,600. He said, I could take that money out and give it to you and you could go spend your bike. Or we could leave your money in the account and I could loan you $1,600 at 5%. And,
wow.
And I said, well, why would I take a loan when I can go take cash, when I have the cash? And he says, because if we work out the numbers, so let's work out the numbers here. It's $1,600, and I'm going to pay it back at 5% over 12 or 24 months, over 2 years. Okay. So I'm going to pay $70 a month. Okay. So if you take
that's including your 5% interest rate.
Yes.
Okay.
So if I take $70 a month times 24,
yeah,
that's
$1,600 plus 5% interest rate.
Plus the 5%, it actually equals $1,680. So $1,680.
That's all? 5% is just $80 interest?
It was $80 over 2 years.
Wow.
So he said, exactly. And he said, if your investment makes more than $80, well then in 2 years, you're going to have your motorcycle and your investment. And it ideally grew. And I said, okay, that kind of makes sense. So this is what we did, is we started and I kept my money invested and I paid him back the $70 per month.
Wow.
And over 2 years, I had my bike paid off and I had my investment. It actually grew by $400. So I had $2,000 plus my motorcycle.
That's amazing.
Okay. Now, the market was great at that time, but the market could have gone down. Here is where we have to really understand something, and there's the human factor. It's much easier to pay down a debt than it is to save money. So as a 16-year-old person, if I took $1,600 out and I go and buy my motorcycle, what are the chances that I would pay $70 back to myself for the next 24 months back into my investments?
Yeah.
What are those chances?
As a 16-year-old, very unlikely.
Probably pretty low.
I mean, as a 30 or 50-year-old, unlikely if you don't know better.
So let's look at something here. So what's the true cost? And when we talk about, we can spend cash or we can finance.
Okay.
Okay?
Yeah.
So in reality, if I take $1,600 present value,
okay,
and I made 5% of that money over 24 months, $1,600 grows at 5%, 24 months.
Yeah.
So this investment would have grown to $17,670.
So you made $107.
So this is one example. If I spent this cash,
yeah,
I would have lost
$107. Yeah.
Right. But I would have had that $70 extra per month.
But you would have wasted it.
Okay. But if I was able to save it, and we use the same characteristics, so it's $69.90 over 5%. It equals the exact same. So what this is showing is once you understand lost opportunity cost, and once you put it into your verification of your decision making, that if you spend cash, it's going to cost me, I'm going to lose the potential of that money growing, but then I could save and it could grow to the same amount. Or I could borrow and that money is going to grow at 5% anyways. So if I spend cash or if I borrow under the same characteristics or the same time period, it costs me literally the exact same thing.
It's just that likely people aren't as disciplined with cash.
Exactly. So then when we bring the human factor in, we can easily see it's much more effective to keep our money invested and to use the OPM method to finance things in our own life. We'll actually end up a much higher and much better rate. So that's the basics of understanding the how to become your own banker.
Yeah.
So let's look at what an example looks like with actual numbers here. So in this example, we've got a male age 40.
Okay.
We're going to put 15,000 in for 12 years. And this is what's capitalizing our bank. It's starting our bank up.
Yeah.
Okay, and so there's the deposits.
Sorry, this money is going into a
Whole life insurance policy.
policy.
Yes.
Okay.
There's your cash value.
Yeah.
And there's your death benefit.
Okay.
Okay. We're going to buy a car for 35,000 every 5 years starting in year 3.
Okay.
So you can see we have to start in year 3 because it takes us time to accumulate the cash.
Yes.
So that we can use it as collateral to get a loan.
Yes.
In this example, we're taking a loan for 5%.
Okay.
Okay. Now you might
Is
also
that a really good rate for like how much?
No, that's aggressive. Like right now, rates are much lower than that.
Yes.
Yeah.
Okay. That's my question. Yeah.
Right now.
Okay.
But I want to test this under any circumstance.
Yes.
I want to make sure this still works.
Okay.
Then we've also said something here, self loan rate of 3%.
Mm-hmm.
So we're actually charging ourselves an 8% interest for this car loan.
Mm-hmm.
Now, why would we charge ourselves an additional 3%? Because we are the depositor, we are the banker,
Yeah.
and we are the borrower.
Okay.
We wear all 3 hats in this scenario.
Okay.
If you put your banking hat on and you're going to loan money to somebody, do you want to loan it to them at the same rate you can get access to the money?
No. You want to make money on
You
it.
want it spread.
So we are the depositor, the
Banker
yeah.
and the borrower.
Okay.
Those are the 3 parts of any bank. Now we are all 3 hats and we have to wear them separately.
So
we're charging ourselves interest. What's happening is this creates about a $9,000 yearly payment,
yes,
and about $1,000 of that $9,000
is paying ourselves.
is self-loan rate. So what's happening internally is that we're going to pay more money back to our own bank. The 3% is going back to us. The 5% is going back to another institution or the insurance company
Yes.
to pay back this loan that we borrowed.
Yes.
Now remember, we never touched our money. So our money still got that internal rate of return. What's that internal rate equal to? It was like 9.3%,
Yeah.
9.4%. Okay, so we're not touching that. It's never being affected.
Okay.
We're using other people's money. We're borrowing $35,000. We're going to buy our car, and we're
Yes.
making $9,000 payments back
Yes. Over 5 years.
over 5 years.
5 years. Yeah.
So 15,000 times 7,
Yes.
7 years, is 105.
Okay.
9,000 times 5 is 45,000.
Mm-hmm.
So our total outlay is 150,000 in the first 7 years,
Okay.
and we've got a car.
Yes.
Our growth in our policy is 110.
Okay.
So if this is out of your pocket and this is into your pocket, how much does the car cost you?
40,000.
40,000. So by doing this once, we've recaptured 5,000 of interest because we paid 45 for the car. Most of that 40,000 was going back as our self-loan rate, so it's going back to us.
Yes.
But now what we're going to do is we're going to buy another car. So we've got lots of cash value. We're not even utilizing all of this money.
Yes.
Ultimately, the more money in motion we can keep, the more rate of return we can make.
Okay.
Okay? So we're still continuing to put money into our policy, the 15,000, and we're still paying back the 9,000 because we bought another car.
Okay.
So over these 5 years, our total outlay is 120,000. So the growth in the policy went from 110
Yeah.
to 230.
Okay.
That's a $120,000 growth.
Yes.
Out of pocket 120, into pocket 120. How much does the car cost you now?
Well, 0.
Exactly. Now, let me put a disclaimer in here. If you didn't buy a liability, if you didn't buy this car, which is a liability, you would have an extra 45,000
Yes.
if you saved it.
Yes.
And most people are buying things anyway. So I'm not saying like it didn't actually cost you anything. It still cost you 45,000 to buy the car because that's still a liability.
Yes.
But this is just the best way to buy liabilities.
Yes.
And you can see now in the next time we buy a car, we've got lots of money to finance that car. We stop putting money into the policy. So at this point, the policy is self-sustaining itself. We're taking the dividend. We're actually paying for the premium with the dividend now.
Great.
So you won't see the death benefit.
But would it be good to continue to pay into it?
It would definitely be good. If we can continue to pay, it's going to increase even more.
Yeah. So ideally, you want to have your premium, even once your dividends are covering the cost of your premium, you want to keep paying that premium, because it's just like you're now used to putting X amount of dollars into this, and if you can just forget about that money.
Yeah, it totally depends on how we set it up and what we're trying to do. But throughout this time, you could lose your job, you could switch jobs, you could have lower income, you could have higher income, you could have all these different life changes. And that's what I help you navigate is how does this work long term, and how does this work with my change in life?
Okay.
But in our 13th year, we're buying our third car. We've got lots of cash value, and now we've stopped the payments into the policy, but we're just putting the $9,000 in.
Yeah.
So over those 5 years, we put $45,000 in, but now the growth is going up, and in that 5 years is going up actually more than we're contributing for the car.
Wow. Yeah.
And so we're
Now
just
you're
going to
making
keep
money.
Exactly. We're just going to keep doing
I
this.
love this idea to make money off money.
Yeah, and you can see the growth is just keep going up every single 5 years. And if we go all the way to the bottom here, we're going to say you drive your last car at 82. Maybe you can go longer, we'll see. With self-driving cars, people are going to drive into their hundreds.
Yeah.
So, but in this case, we're driving all the way to 82. We've got the growth over those 5 years was $250,000.
Whoa.
You've got $1 million of cash value and 1.4 of death benefit.
Wow.
So let's do a review of everything. You've put in $180,000 to start your policy, to capitalize it, to build your bank up.
Yes.
You've bought 8 cars for $360,000.
Yes.
And their total outlay is $540,000.
Okay.
We now have $1 million of cash and 1.4 million of death benefit.
Okay.
Okay. We can use this cash value for tax-free retirement income. There is even ways to use the death benefit to maximize your retirement income using other strategies. And that's something else I teach. If you pay cash for your cars, if you finance through the dealership, or if you lease your cars for your whole life, how much is going to be in your bank account from all those cars at the end of your life?
Zero.
So by doing something like this, do you have to work any harder?
No, you're just working smarter.
Working smarter. There's probably a little bit you have to learn for sure to understand the concept. Do you have to take on additional risk?
Yes. No.
If anything, we decreased your risk. We're giving you more benefits from a death benefit coverage, and maybe helps your family anyways. And did we have to change our cash flow?
No, because it's the same amount of money going into this, and now money's growing on its money.
Right, and because people are saving money anyways in different vehicles, and they're probably losing money unnecessarily and unknowingly that we can recapture, we can bring back to the table. And you're probably paying monthly car payments. If you pay cash for your cars, then you gotta save for the next one. So we're gonna look at one last visual to help put everything into perspective.
Okay.
So I call this the zero line. So this person has 0 assets and 0 liabilities.
Okay.
So if they want to go buy a car or something, they have to go below that 0 line, right?
Yes.
So they have to go into debt.
Okay.
So if they go into debt, they're going below the 0 line, and then they're going to have to pay that back over time. And then they get back to the 0 line eventually, and what do? Well, they're going to go buy another car or buy something else. They get back and they do it again. They kind of do this throughout their life. They buy and they spend and they pay back and they end up on the 0 line.
Yeah.
So this is the first way to buy something, is we can borrow. Why do you not want to borrow money to buy something?
Because you need to pay interest.
Yes, because you have to, what I like to call pay up. Okay, so you have to pay up the interest. So they say, well, you have to save. And you have to pay cash for the things you want. Because if you save, you have to save that money, and then you're not going to pay any interest. But what are we forgetting?
Lost opportunity costs.
Lost opportunity costs. Lost opportunity cost tells us that if you spend cash or if you borrow, the cost is going to be the same.
Yeah.
Because you either pay up or you give up the money that would have been there. And see, when people save money, they get to a point of saving and they have to drain their tank down to the zero line.
Yes.
And then they got to save up again.
That's what I do.
And then they got to save and spend, save and spend, save and spend, and they actually end up right on that zero line with the person that was borrowing. And see, in that first savings, you lost.
Which is so interesting because I always thought I was in such a better position.
Yeah, and most people do, but this is to see this. See, this is how money would have grown over time. And when you spend and drain that tank, you save money back to buy something again, but you never saved what you would have made. Okay, so there is a third way to buy something, which is in most people's blind spot, and we call that the private financing strategy that we just talked about. And so what this looks like on this graph is that we're going to save our money and we're going to let it grow long term, and we're never going to touch the curve. And that's your cash surrender value. That's going to grow forever.
Surrender value?
Yeah, that's what we just talked about for the policy.
Yeah.
And we're going to borrow against the curve. And we're going to buy all the same things we would have bought, but we're going to end up way up here.
That's where I want to be.
Yeah. So this is just a better way to purchase all of those things in life that we want, whether it be an asset or a liability. All right, the last thing that I want to show you is my own policies.
Ooh.
So I started, when my dad told me about this strategy and these policies when I was about 18 or 19. I was in college at the time, and I actually I started understanding the concept. I knew I needed to get in right away.
Yeah.
Has anyone asked you the question, when's the best time to plant a tree?
Yesterday.
Yeah, 20 years ago. The second best time is right now. And I understood that concept. I used my OSAP money to start this policy.
Oh, this is your own little policy?
This is my policy. Yeah.
Adam's Emmanuel policy.
So I was putting in $6,000 a year when I was 19.
Wow.
And these are the projections they gave me. So again, I just wanted to clarify. See, if I started a year later, I wasn't losing the growth in the first year. I was losing the growth in the last year.
Yes. Yes.
That's a $200,000 decision. So the earlier you can get going, the better it's going to be, because you're going to have longer to compound. This is why it's great for kids. These are the projections they gave me when I was 19.
Yes.
These are the actual cash value that I've experienced.
Oh, okay. So because this is fluctuations of the economy.
Yeah, this is the dividend scale. So in 2008, you can see it went down, but I still got a dividend that year. I have another policy that I'm putting $20,000 a year in. I started when I was 24. These are the projections they gave me, and these are the actual cash values that I've received. Right, so I show these.
So these accounts both have actual cash values of that much in it right now that you started, 24, 25, 19.
So I show these for two reasons. Number one is that everything that I teach clients is what I'm doing in my own life. I did learn that pretty early, is that I will never sell anything that I would never buy myself.
Yeah.
So I want to make sure that I'm following the rules for prosperity that I teach, and all of those things that I use to maximize. And I want to help people maximize their wealth as well from a macro view. The other reason is to show you that the projections I'm showing you today, I'm comfortable and showing, because even if in the last 10 years the dividend scale has gone down, that's why my value is a little less than what they predicted, but it's really not that much. Yeah, the older these policies get, the better they go and the more efficient they are. Like for this policy, I put in 76,000, and it's up to 86. Okay, so now that you have a basic understanding of the private financing strategy, if anything in this video intrigued you and you want to learn more how you can apply this to your life and help you and your family grow in your financial future, then the next step for us is to set up a 15-minute chat just to talk about where you want to go, what you want to do, and what our process going forward looks like. There will be a link below in the email that you can set up a 15-minute chat with me, and we can go over what's important to you about your life and your financial future. I hope to talk to you soon. Have a great day.